Any idea? Okay. Now, in the trading of bonds, we have trading in the primary market and then trading in the secondary market. And I don't like to, let me take off what I've written so that you can listen to me. Otherwise, you'll be reading. So we have trading in the primary market, and then we have trading in the secondary market. I know you know about primary and secondary. So the initial call for investment is what is done in the primary market. The initial call is what is done in the primary market. Let's say when a government launches a bond to raise funds, at the first time, that is when we say it is in the primary market. Then after the bond has been traded, it moves into the secondary market, where we have investor to investor trading. Okay, so someone has some bonds he's not able to keep till maturity and he needs the money. He will trade it in the secondary market. And there comes pricing. There comes pricing in the decision of whether to buy a bond or not to buy a bond, whether a bond is priced at premium, priced at discount, and then whether a bond is overpriced or underpriced. These are all different. When you talk about premium and discounts, they move together. Then overpriced and underpriced also move together. But what are the indicators for premium and discount bonds and overpriced or underpriced bonds? So that is where I want to draw the line and make the clarification. Okay. So in the secondary markets, you have what we call the market price. That is acted upon by demand and supply. So you have the initial trading done in the primary market, where your par value is fixed, your coupon rate is fixed, and the time to maturity is also fixed on a certain contract or document that is owned by the investor. So during the initial purchase or in the trading during the primary market, the initial purchase, there's a fixed duration for maturity. And then there is the par value or the face value, which is the principal that is going to be received at the end of maturity. Then you have coupon rate that is also fixed. Good. And then the price at which the bond is being sold, fixed. All that, so the initial stages, all that are fixed. And we say that a bond could be trading at par, at premium, or at a discount if the coupon rate equals the market interest rate. So that market interest rate, you're looking at other bonds that are being traded, what interest rate they are running on. So once the coupon rate is equal to whatever interest rate the market is offering, you say the bond is trading at par. If the coupon rate is higher than that of the market rate, the bond is trading at a premium. If the coupon rate is lower than that of the market rate, the bond is trading at a discount. But what I want to clarify is that at the beginning, coupon rate is fixed, par value is fixed, maturity is fixed. Then we trade in the secondary market. In the secondary market, you have price movements, but par value is not affected. You have price movements, face value is not affected, or par value is not affected. And then coupon rate is also not affected. That remains constant as stipulated on the contract. But if you are selling in the secondary market or you are trading in the secondary market, you want to buy a bond in the secondary market, and then you realize that price have changed from the par value. What do you do? Or how do you determine that? So you have price changes in the market that does not affect the par value. Does not affect the par value, but you are buying it at a certain premium or at a certain discount, though your par value is not affected. Okay. Now, when we say that a bond is overpriced, what it means is that the market price is higher than its intrinsic value. This is where the clash is. And when we say intrinsic value, that is the value the investor expects to receive. So that when you do your own calculation, you are asking yourself whether the price at which the bond is going for is at its normal price. Is it overpriced or is underpriced? As in, this item I'm buying, am I buying it at its worth? Is it worth the value? Is it overpriced or is it underpriced? That is a comparison between the market price, yes, and your calculation of what the bond price should be, or your expectation of how much you expect to earn from that bond. I'm saying how much you expect to earn from that bond with the eye of equities, and we'll get there. But then when you are talking about bonds, when you have done your own calculations and you look at the price and then you look at the market, you tell yourself that, oh, this bond is underpriced, which means that when you did the calculation, your market price is lower than the intrinsic value. The bond is worth more than the price on the market. That makes the bond attractive. You will buy. It's like going to buy a product that has been discounted in the market. No, let me not use discounted to confuse you. That has been underpriced in the markets. You saw what? Some bags, and you know the value of the bags. And then in that shop, the prices were looking really, really good. You tell yourself that, hey, these bags are underpriced. You buy it and go and sell it to your colleagues who also know the normal price. Until when you go, you beat it down a bit. So you beat the normal price down a bit so that you have an advantage over the market. That is underpriced. So when the bond is underpriced, it's good. It goes favorable to the investor. After the investor has done the calculations and understood that the intrinsic value, the real worth of the bond, which is the calculations we are doing, then you will be able to determine whether the price at which it's being sold in the market is what it's supposed to be. Will you want to buy or will you not buy based on whether the bond is overpriced or underpriced? When the bond is overpriced, it is not worth it. It is not attractive because you are buying something that is not worth its value. That is overpriced. And then underpriced, you are buying something that is worth more than the price is being sold. And that is underpriced. Then when you go to discounts, we say that the bond is trading below its par value. This one is because of the market playing on profit on the price. Increase in demand leading to high price, decrease in demand leading to low pricing. where there's an increase in demand, you will see that the bond is trading at a premium. The price will be higher than its par value. And investors will pay more, will be willing to pay more because of what they intend to gain from the bond in the future. And when the bond is discounted, other groups of investors will buy at its discounted price with the hope that prices will shoot up. Okay, let's take an example. Let's say ABC Limited issued a bond with a par value of $1,000 and a coupon rate of 12% per annum. That means that annually, people are going to earn 120 in coupons. At the end of the time of the issue, the prevailing market interest rate was 12%. So the bond is issued at its par. Market value is 12, par value is 12. So it is just issued at par with the same, every bond that is $1,000 is given a par value of 12%. So on the market, everything is okay. So you take it as it is at par. After some time, market interest rates begin to fall to 8%. Now new bonds issued in the market are now paying $80 per year for coupons at the same par value of $1,000. So these bonds, ABC has been sold in the market already. Then months down the line, market interest rates begin to fall. So you see that the new bonds that are coming are running on the new interest rates. Interest rates are falling to 8%. It's like, let's compare last year and this year. The interest rates came down this year or late this year. But let's compare the previous interest rates we were having at the bank and then what we are offering, we are receiving now. I think Bank of Ghana rate is 18. Some time back, Bank of Ghana rate was as high as 28. So if we are using those two rates for bonds that were traded at that time, the interest rate was high. But now, currently, interest rates have generally come down. It means that bonds that will be traded now will come with the new interest rates lower. So considering ABC's bond, that was giving 12% interest or coupon rates at par value of $1,000. Each person receives 120 for holding that bond. Then months after, we have another set of bonds that are introduced into the market with lower interest rate because interest rates have just generally gone down. You realize that now these new bonds will be bond holders. Anybody who buys these bonds will be getting $80 per year instead of ABC's 120 that was trading before. This automatically makes ABC very attractive trading in the secondary market. And people will be willing to pay more to have ABC, even at a rate of, if ABC decides to sell for 1,150 at that price for its price, so even though par value is still 1,000, but the market price of ABC shoots up just because demand is rising for ABC. Market price for ABC now becomes $1,150. People will still buy ABC. Why? Because even if you bought ABC at 1,150 with a par value of 1,000, you will be earning 120 for coupon. every time compared to the 80, 80, 80 if you decide to buy the other bonds. So when you look at your returns from coupon, you realize that you can make so much more than the 150 you are losing now for buying it at premium. If you buy it at premium, you are buying it at 1,150, even though it has a face value or par value of 1,000. You will still buy, because if you compare the coupon that you are earning, 120, 120, 120, you would earn more for holding that bond than losing 150. So you will not mind losing $150 to earn more, just because interest rates have naturally gone down. Are we clear on that?
Yes, sir.
Yes, sir.
Yes. So investors will have different reactions based on what they are looking at. For optimistic investors, even if there's a question, I think somebody's posed the question here. I can't see the question. Okay. Yes, so those are the dynamics. And I want us to be particular about the technical term of overpriced and underpriced. Overpriced and underpriced goes with our own calculation of what we think the bond price should be. Then we'll say that this bond is overpriced, I will not buy. This bond is underpriced, I will buy because it's cheaper. Then we have the ones that are trading on premium. Premium is different. You will still buy the bond because what you are earning from it, even though par value is less than the price, you'll be earning more, and so you will go for that. Okay, so that's what I wanted to clarify on the bonds. Then we move into today's topic. Today's topic of, where is my okay. Today's topic is on equities. Equities. So what are equities? Somebody help us define equities. Somebody help us define equities. Okay, I heard part owner of equity or a company. I didn't hear the rest. Okay. Okay, I'm not. So I think you said equities has something to do with ownership. Yes, I think I got that. Then Isaac says equities represent ownership. Yes, equities represent ownership. So under equities, we'll look at concepts, we'll look at valuation, then we'll look at how it is applied. So equities represent ownership in a company, and it provides shareholders with a residual claim on a company. A residual claim, as in it provides shareholders an opportunity to own something, in a company, or to maybe become part owners of the company. Now, why do people purchase equity? or maybe let me say, how does equity work in comparison to bonds? Bond is a debt instrument, and then stock is an equity instrument. When you compare shares or stock with bonds, what are the variations of their behavior in the market? They are two varied things. One is a debt, the other is an equity. Like what other word can we give for equity? Synonyms of equity. Something like something that you own. Yeah.
Okay, can you say shares?
Yes, shares. So why would somebody buy shares? Or let me say that, how does the two vary between bonds and shares? What is the distinctive variation between bonds and shares?
Shares, with shares, you can earn dividends. Or
Okay, with shares you can earn dividends. Yes, and Isaac also says equities return dividends. Yes, so shares give you dividend, and bonds will give you coupon and then give you back your money. So when you buy shares, what do you gain? Apart from dividends, what do you gain from buying shares?
Madam,
Okay,
please.
madam, you can
Isaac,
also
please.
enjoy capital gains as a
There are,
shareholder.
as capital, you have capital gains as shareholders.
Yes.
Yes,
When
there was another voice.
Yeah, Doc, please. It was me. I was going to say the same thing as Gilbert said.
Okay,
Thank
so we
you.
have capital gains. Thank you. And then Isaac says shareholders are entitled to vote at AGMs, that is annual general meetings, and they become owners of the company. They become owners of the company. Yes, so these are the theoretical aspects of shares.
Hello, Madam.
Yes.
Can we also say that equity comes with a higher risk, but then comes with a higher returns, while the debt instrument has a lower risk, but also comes with a lower return?
Yes, equities come with higher risks and we expect higher returns, whilst debt instruments comes with lower risks and lower returns. And that is very, very true. That is why a lot of people don't buy shares, because a company can decide not to declare dividends. It means that you went the whole year without any profit. And when you go into agency problem or agency concepts, you would realize that sometimes equity holders have spent money to invest in companies where their agencies or their agents are, lavishing on the money to the detriment of the shareholder. And so there are so many consequences of being a shareholder, but it's a very bold step for people who are looking for very good investments to make. That is a good place to make investments. So you also need to understand how the market plays so that your investments can yield. And then when they call for annual general meetings, you must attend if you have made investments, because you get the chance to, that's the only one time you get the chance to make a statement about your money, to make decisions about your money. The whole year you have your agents, that is managers, managing your money. If you invested in a company like MTN, I like to use MTN because their shares are doing well. And I like the ice cream sellers. What's their name? Yeah. So you've invested in a company like MTN, and you see how the whole year, every decision they make is supposed to push the value of MTN. But again, you realize that though management is working to push the value of your shares, they are also working in their own interest to pay themselves very well. So when you get the chance to attend an annual general meeting, that is the only time you are able to speak or vote. Let me use the word to vote on an issue that you think will affect your equity. And we are not going to go into the other parts, even though I stated them here. I don't want to go into that today. The takeovers, how you can actually deal with management with your votes, and perhaps take some of them off, vote against issues and all that. We are looking at more of the evaluation than when you do corporate finance, you will meet it there, and then you go into details on that. So we've talked about the capitals that you are getting from it. You have returns from capital appreciation, and then you have returns in terms of dividend when you are dealing with equities. Now, what is the relevance of, or let me go to the types of equities. We have convertible equities or securities. We have employee securities. We have preferred and common shares, and they are all in the theory, which I think are below your pedigree for now. So though it is there, we are not going to spend too much time on that. You have common shares, preferred shares, and then you have convertible securities, employee stock, where some companies allow employees to own part of the company. If you own part of the company, your money is there, so you treat it well. What is the relevance of the equity markets? Why is the equity market so important? Even though we have the debt market, why is the equity market so important?
Give investors the opportunity to become owners, part owners of big companies.
Okay, it gives opportunities to investors to become part owners of big companies. Yes, to become part owners of companies that you never dream of being part, like Tesla. It gives you an opportunity to own. Then I hear investors buy ownership stakes in companies. Yes. And it provides capital for companies for growth. Yes, Papa Sam says it provides capital for companies to grow. And then this is coming from Gilbert. Investors buy ownership stake. I want to make sure Deborah said it gives you the opportunity to become a share owner of the company. Okay. Yes. Then I have, it provides liquidity to investors. Provides liquidity to investors. Yeah, that's from Abdul. Abdul, you mean investors as in the company? I guess that's what you...
No, not solely those holding the shares. Who wants to
Okay,
sell it? They can sell it in the equity market.
in the liquidity market. Okay,
Yes.
that's if you have very good shares. Okay. Then Gazy says companies are able to raise funds for growth and expansion. Yes, very important. Companies are able to grow raise funds for growth and for expansion. Yes, so thank you very much. That gives us the relevance of why somebody will say that a company will say we want money and we are going into the open shares or stock market, because it gives you the opportunity to raise funds to run your business and not look back not look back as in, because it's not a debt instrument, you are not obliged to pay back at a specific time. So it gives you room to play, do your best. Gives room for the company to go through its teething periods with investors who are patient with them till the company picks up and become stable enough to pay dividends. Okay. I just want to make sure I'm not jumping anything. Then let's talk about preemptive rights. Preemptive rights. This is a right that's given to existing shareholders. Whenever there are floating shares, preemptive rights gives shareholders the chance to be the first to be offered the shares to buy. And then when they are done buying, other new investors can attempt to buy. So that is a preemptive right, where it gives shareholders a chance to, okay, I'm coming, Ibrahim. It gives shareholders a chance to buy shares at the point where the share is being floated. At the point where the share is being floated, we say that it gives you the first chance. Ibrahim, let me hear you.
Yeah, Doc, I have a question, please.
Yes, please.
Yes. Do equity market always reflect the true value of company?
Again.
I mean, do equity market always reflect the true value of companies? Whether it reflects the true value of company?
Ha 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 ha. Even that true value, you would have to calculate. That is why at the end of the year, they publish their statements. Then if you are a concerned investor, you go and look at their statement to find out what exactly is happening to your company. It is now your company. So you want to find out what exactly is happening to your company, and then you can now determine whether your value is a true reflection. Okay, but that is why you also do the calculations that we are learning, how to value stock, to see whether the intrinsic value of the stock is what is reflecting on the market, really. Yes, so whether it is or not depends on these factors, whether how your bank statement is performing, how your income statements and the other books are performing, and then how you are also performing on the market. You can even be affected by just investor perception. Investor perception is enough to drive prices up or down. And so, yes, that becomes it. Yeah.
All right.
Okay. Yes, so for preemptive rights, one of the reasons is to preserve ownership percentage. Let's say you have a percentage of 5 or 6% in a company. When they increase the shares by floating shares and we have new people buying in, you realize that your share percentage goes down. So they give you the opportunity to be the first to buy enough to maintain your percentage of shares before they go into issuing it out. Okay. Yes, Ima.
Yeah, madam.
Yeah.
As you said, After that, if they want to give them the primitive right to buy the shares, would they give to them the original shareholders? Would they give them at the same price as they will offer to the public?
It depends. Sometimes it's given to them at a reduced price. Sometimes, depending on what, just like the company decides to give you dividend or which percentage of their profit they want to give out, it also depends. But what they are interested in is to make sure that the share is not diluted so that you don't own your percentage of ownership. Because as for price, remember that even the price at which it's being sold is being determined in the market by demand and supply. So it doesn't, you are not privileged because the company is giving it to you at a certain price, up or above or below. But if you are holding a very good share, the market is playing on price, and price will go up just because people have preempted that you are doing well. Like I'm saying, MTN is doing well. MTN is doing well. Somebody will just go and buy MTN because I said MTN is doing well. And you can see from the records that MTN is, once that MTN is doing well runs in the minds of people, they will run to go and buy MTN. Automatically, the price of MTN shoots up, even if their books are not showing very good records. At the points where the market is trading, the market is not able to tell what is really happening in the books of the company. But the financial market is playing on price, either going up or going down. So your apart from your financial statements and all that, the market itself plays a role. If somebody wakes up one morning and decides to sell a huge amount of shares for a low price because the person just maybe has put the shares up for some time and nobody's buying, they really, really need the money, they will beat down the price and sell it. Then automatically, you see that the price of your shares have just dropped just by that one act. But like I said, you go to go to any of the banks and say you want to buy fan milk, you won't even get. You can be on it for 3 months just waiting for someone to sell their fan milk so that you buy. You won't get, because fan milk is doing well, their dividends are good, and so everybody is holding that share. They won't sell it. So you see that then, as there's more demand coming in for that particular share, the price continues to shoot up till the price shoots to a point where an existing investor, existing shareholder sees that the price right there, this price is good, let me take it, and then he sells. Otherwise, you will just be holding it and waiting, looking for fan milk to buy. It's same as MTN. There are others. I'm not privy to a lot of them informations they have. So yes, but there are a lot of very good shares. Sometimes we are just too let me say, we are too laid back when it comes to investing in shares, and maybe you have some 2,000 somewhere lying somewhere that is just sitting in the bank. Oh, that 2,000 has been sitting in the bank for 6 months. You have not used it. The money is just lying there. If you buy shares and close your eyes, obviously that money is just there. You are not using it. You realize that you will make a good amount of money. Though it is also risky, you could lose all that money and not get it back. Yeah. So that's it. Let me move to, okay, I've talked about dilution. Let me talk about classification of shares. We have what we call the founder's share. This is generally used to classify shares for owners. I remember when I was a student learning about shares, and I starting from how do you call it, companies, where you say you have sole proprietorship, partnership, then you come to companies. So let's say someone started a business, the business is doing well, that was a sole proprietor, then he got partners, and then they did what to a point where they decided that, okay, we want to go into the open market to float shares and get more investors, get more money, and expand and grow. At that point where they go into the public, they become exposed. And I was feeling bad for the how do you call it, the developer of the idea, the person who started the business, the heart with which they started the business, the sacrifices they've made towards the business. And then when they go into the open market, they stand the chance of losing even their take in the market. Then I came across founders share, which allows the classification of shares into class A or class B and so forth, depending on what the classification is. Yeboah, hey, I think it's Yeboah Daniel. Your pencil is writing on our screen. Sorry. And it gives enhanced voting rights. So sometimes it is how the share is priced to the founder, which is maybe class A. The share will be lower, priced lower, or it will be given a voting right, so that for one share, he has, let's say, 10% voting rights, 10 votes to 1. If he owns one share, he will have 10 votes. And those are written in their documents to help the founder not lose out on decision making for the business. Because let's see, in the case of Facebook, Mark Zuckerberg, that's exactly what he did. And then you are not able to determine to him what Facebook should go into or what Facebook shouldn't go into. And the recent one was the AI invention by Meta. The AI invention by Meta. There was a case on that where investors were not for the AI idea, but because of Zuckerberg's shareholding votes, the votes he had, he was able to vote for the implementation of AI. And that is why we see a lot of AI all over the world. We haven't looked at the implications of it, which I think that was what the other investors were looking at. But yeah, Zuckerberg is a businessman and he has an idea and he wants to run the idea. So yes, if you were a business owner and you've run your business for over years and you've gone public, and then now people from nowhere decide to tell you what to do with the business, you can understand. Yes, so these are rights given to owners to protect their interests when it comes to the business. Please let me know when I'm going too fast. Okay. All right. Then we go to distribution of shares. So we are almost at the end of the theory. Then we'll go into the practical. Distribution of shares. Now, when companies make profit at the end of the period, we have what we call the payout policy, which is determined by each company and how they want to be. Now, companies can choose to have alternatives between what they do with their free cash flow. So you may want to retain your cash flow or pay out part of it to your investors, your shareholders. If you retain, you would want to retain to invest in new projects. It's like you made profits. You don't want to give it out. Let's go into new projects so that this profit can earn more. Or you may just want to increase your reserves. But if you want to give out, which is the payout option, then you are having two options. You either pay dividends or you are doing share repurchase, which is another way of letting out money into the hands of your shareholders by repurchasing part of the shares they hold. And that is called share repurchase. Okay. We'll pause at this point and go into the theory, the calculation part of this, which is very broad. So I want to go into it as quickly as possible. Before we start, any question? And then I'll say, let's bring up our calculators. Any question on what we've done so far? This is the theory part, and I know you are quite vested in that, so let's shoot. Okay. So from last week, we mentioned that when you are calculating present value of an instrument like a bond or a stock, it is made up of the valuation of all its streams of income. All its streams of income. So the expected stream of income and then the required discount rate. You are looking at, if it is a bond, you are looking at coupon. Then you have the principal at the end of the period. If it is for stock, you are looking at dividend. And then when you sell it at a point, you have price appreciation and you get some money from that. So the valuation goes into valuing all streams of income. Now, one basic principle of finance is that the value of an investment is found by computing the value today of all its cash flows to be generated in the future. So all that you expect to have in the future is being discounted into today. And that is how valuation is done. And the simplest scenario we will start with is to do the 1 period valuation. The 1 period valuation. If you hold a stock for 1 year, how would you value that stock if you are holding it for 1 year? 1 period valuation. Suppose that you have some extra money to invest for 1 year. After a year, you will need to sell your investment to pay tuition. After watching TV3 News, you decide that you want to buy Intel Corporation stock. You call your broker and find that Intel is currently selling for $50 per share. That is the current price, $50 per share, at an interest rate of 12%, and it pays 0.16 per year in dividend. $0.16 per year in dividends. Now, the analyst on TV3 predicts that the stock will be selling for $60 in 1 year. Looking at the behavior of the stock in the past, he's estimating that if you look at the trend analysis of this stock, it has been doing quite well. And for price, we have seen price appreciation over the last 4 years. So we can predict that the shares will be selling at $60 by the end of the year. Should you buy or should you not? Based on what are you going to say you want to buy? Is it based on his review of the historical data? That is where our question comes in. To answer this question, we need to determine whether the current price actually reflects the forecasted. Whether the current price actually reflects the analyst forecasts. 2, we need to find the present discounted value of the expected cash flows. How much will the price be? Or what would the price be if we consider dividends to come, the interest rate, the current price, and we discount it into today's terms, present value? What would that value be? The cash flow for stock valuation consists of dividend payment plus the final sales, which is price appreciation, difference between two prices. So it is not any different from that of the bonds. The bonds also looks at cash flow that is coming in, and then we find its present value. Now, let's pay attention to these. Anytime we are dealing, you see D, it will stand for dividend. When you are dealing with stocks and you are doing valuation, when you see D, D will stand for dividend. P will stand for price. Then we will meet G, we will meet K, KE as we move on. So DT will stand for dividend the stockholder expects to receive at the end of year T. Dividend DT will stand for dividend the stockholder expects to receive at the end of year T. D0 is the most recent dividend paid today. D0 today, dividend paid today, or the most or last dividend that has been paid by the company. D1 is the first dividend expected at the end of 1 year. So if you are standing at D0, D1 will be the dividend you will receive at the end of 1 year. D2 will be the dividend expected at the end of year 2. So D0 represents dividend in year 0, or the very recent dividend that has been paid. D1 represents dividend at the end of 1 year. D2 will represent dividend at the end of year 2. P0, just like D0. So P0 is for price, which is looking at the actual market price of the stock today. Today. Now, present value. P0 is the present value of price, or the actual market price of the stock today. So that P at T is the same as D at T, the expected price of stock at the end of year T. Please, if your mic is on, kindly mute it for me. Leslie, kindly mute your mic for me, unless you want to ask a question. Thank you. So P at T means the expected price of the stock at the end of time T, or year T. Then we come to D1 over P0. D1 over P0. the expected dividend yield during the coming year. Yield, dividend yield during the coming year. If a stock is expected to pay a dividend of $1 at D1 at the end of 1 year or during the next 12 months, the stock is expected to pay a dividend of 1. If its current price is $10, current price P0 is $10, then the expected yield will be D1 over P0, which is $1 over $10, giving you 10% of yield. 10% of yield by the end of 1 year. Are we copying this one, or should I move on, please? Okay, that is a move on. Okay. Then, let's look at the expected capital gain. Yes, somebody says. Okay, we've copied. Thank you.
I'm not over. Can you go back? We'll finish.
Do people forget to mute their mics? It's being recorded, so we don't want to have, the interruptions like that, please. Okay. So we have the expected capital gain. Capital gain yield during the coming year, made up of P, price at 1 minus price at 0. So price at year 1 minus price at year 0 over price at year 0 should give you a percentage increase in price. Let me say. So let's say P0, the last price of the stock is $20. And then P1 is $40. At the end of 1 year, we had $40. So P1 is $40. P0 is $20 divided by $20. You want to look at the percentage gain in terms of yield. So when it comes to price, so you have $40 minus $20 over $20, which gives you 10%. If my calculation is right. I have an example here. Okay, if the stock sells for $10 today, and if it's expected to have a rise in price of 10 to 0.5 at the end of the year, the expected capital gain will be P1 minus P0, which is $10, 10.5 minus 10, which is equal to $0.5. And then when you translate it into gain, you have 5%. Yes. So that gives you the percentage gain in price. The percentage gain in price. Percentage gain in price, or percentage change in price for 5%. Then you have G, which is the growth rate, the expected growth rate in the dividend. So dividends will grow at a certain rate. At what rate is the dividend growing? Or is the dividend growing at all? Or there is no growth in dividend? That will stand for J. So before we move into the calculations, when you see J, it's talking about growth in dividends. When you see P1, you know that's price at the end of 1 year. When you see P0, it means price, the current price. When you see D2, D1, you know dividend at year 1, dividend at year 2, and that is how it goes. Okay. Now, let's go into the 1 period valuation. The 1 period valuation. For holding period of 1 year, the value of a stock today is the present value of all or any dividends during the year plus the present value of expected price of the stock at the end of the year. So in value, you have dividend to be received discounted plus the price at the end of the year also discounted, and that will give you your present value. Again, every share or stock has 2 cash flows coming in. You have your dividends coming in, then you have your cash or revenue or income coming from change in price or price appreciation. So your dividend is discounted, then the price is also discounted. And just like we did in the bond, coupon. Then when it gets to the last year, you have coupon plus principal value. That's kind of thing. Dividend. At the end of the year, you have P, price, also showing up there. So let's translate it into real formulas. So P0, which is the present value of the stock, is equal to DV, dividend at year 1, sometimes written as D or DIV. Dividend at year 1 divided by 1 plus KE. KE is the required rate of return on the investment. Required rate of return on the investment. That is what we estimate that investors will expect for as their interest rate on the investments they have made. Okay. Plus P1, which is price at the end of 1 year, divided by 1 plus K. Also, interest rates expected by investors. Interest rate or required rate of return or market capitalization or discount rate. And this is also written as P0 is equal to D1 plus P1 over 1 plus K. So the formula on the left is the same as that on the right. You can do D1 over 1 plus K plus P1 over 1 plus K, or you can do P0 is equal to D1 plus P1 over 1 plus K. Any of them works. Any of them works. Please copy the formula. And let's move into trying our hands on a question. Please let me know when you are done copying the formula. Or I'll ask if anybody is copying, still copying, and then we can move on. Just the formula. The P0 is equal to blah, 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 blah. That's the one we are copying. Are we done? Anybody still copying? Again, anybody still copying? No. Okay.
I doubt it.
Yes. All right. So let's move to a sample question. Okay, thank you, Papa Sam. Given a stock currently priced at $50 with an expected dividend of 0.16 and an expected price of 60 next year, and a given return of 12% and a required return of 12%, should an investor buy, hold, or sell the stock? Read the question carefully. What you want to do is start jotting. P, which one is D? Is it D1? Is it D0? Is it, so you start putting that down. Is it P1? Is it P2? Is it P0? You start listing down. And I have put a question there. What are we calculating? When you look at the formula you have, what are we calculating? They gave us price, P, at the end of the year. They gave us the dividend. They gave us KE. And they are asking us, should an investor buy? What exactly are we calculating? I need ideas. What do you think we are calculating? Using the formula that you have. I said P0 is for what?
Current
The
price.
market price.
The market. P0, no. P0 is the price, not the market price. And this is why I wanted to make this, I asked this question. P0 is the price. Now you are doing the calculation as an analyst or someone who is going to buy. The market there, they fix their price. The market has fixed price already, it's there. But you are going to buy and you are doing this calculation. And I'm asking, though it is price, what's the purpose of this calculation?
I think it's the value, or
Yes, it's the value, it's the
that we are
price.
calculating.
What
Yes.
what does it stand for? Why are you doing this calculation? Or why do you need to do this calculation when market price already exists?
To find out
Maybe
whether it is undervalued or overvalued.
Please hold on for me. Yeah, hold on for me. I have a call from Dr. Nsia. I want to attend to it. So kindly give me just 1 minute. Okay, sorry. I think because we were using a different link, Dr. Nsian was looking for us. And Joyce, I thought he had received the link, so I didn't give it to him. So sorry. Okay. Okay, so we said to value whether the stock is overpriced or underpriced, and that is very correct. And technically, we will say that we are looking for the stock's intrinsic value. Technically, we will say that we are looking for the stock's intrinsic value, the real value of the stock, so that we can compare with the market to see whether it is overpriced or underpriced. So Thierry said we are looking for the value of the stock. That is correct. Somebody said we are looking for the price of the stock, and that is correct. I wanted to hear the real price of the stock or the real value of the stock, which in technical terms is said to be its intrinsic value. Good. So now let's do the calculation and then let's ask ourselves, or let's answer the question whether we are to buy or to sell. Please drop your answers in the chat box so that I can see. Okay, Gilbert, I have your answer. Please, when you put the answer there, then you add buy, sell, hold. Buy, sell, hold. Okay, Gilbert, I see your answer. We are waiting for the rest. I'm looking for 10 people. We are 40. So at least 10, dear. We should have answer from 10 people. Don't be tired on me yet. Too. Today is Ire. Aha, Joyce, thank you. Thank you for answering, Joyce. I have an answer from Abdul. Abdul, should we buy or sell or hold? Okay, Sam, I see your answer. Should we buy, sell, or hold? I see Michael. Hainsford, I see your answer. Okay, you added your option. Steven, I see your answer too. How many do I have? It's coming. Gloria, okay. Okay, I see. Abdul, I get your decision. Ibrahim, okay, I get the decision. So I think that we can unveil. Gazy, I get your decision. It is very important to put your calculator and pen together and solve as we do, because it is very, the formula is very simple, but you will just deceive yourself by staring at it. Okay. I have quite a number of people answering buy. Let me see if anybody is saying something different. Okay, good. We have same answer, same decision. Tells us that we understand what we have done so far, and that is good. So, the price of the bond, I have two people, Emmanuel and Isaac. Thank you very much for participating. So we have our value or the price of the bond as 53.71. When we compare it to its current price of 50, we see that the bond has been undervalued, and so we buy. Thank you very much. We buy. Let's try another example. This example say Debbie Corporation stock price is currently 20. It is expected to pay a dividend of $0.8 per share in the current year. Stock analysts predict its price 1 year from now to be 24.5. Calculate its expected return. Calculate its expected return. We have been given ingredients to prepare soup. You look at the ingredients, then you tell yourself that once we have corn, ingredients for soup. You tell yourself that once we have okra, more okra and some ademe and all of that, we're doing okra soup. Or we are not palm nut soup. So your ingredients will tell you. So we are asked to calculate expected return. Let's see. We can start putting our answers in the comments when they come. Okay, I have answers coming in. Okay, I have Abdul, I have Raphael. I have Kingsford, Dinah, Sandra, Nadia. Yes. Keep it coming. Anthony, Gloria, Emmanuel Gazy. Keep it coming. Okay, Michael. All right. So I'm unveiling our answer. We have quite a number coming in. Joyce, thank you. Quite a number coming in. Isaac, thank you. So let's see. Gilbert also has sent his own. Yeah. So we have 26.5 and everybody got it correct. At least those who sent their, yeah, they got it correct. Then Emmanuel. Okay, so you are Emmanuel. The name is, I don't know your surname. So there are too many Imas here. Ima 1 and Ima 2. Yeah. So that's the answer. Anybody here with a question, you need help on how we arrived at this solution before we move on? Okay, that's fine. We are good. Now let's look at the multiple period valuation. So what we did was for one period. If you hold the stock for 1 year, but if there are multiple, because usually you hold a stock or shares for many years, right? So if there are multiple years, what is the valuation like? And I want you to take note of the very last part of the years. So the formula goes as these: P0 is equal to 1 over 1 plus K raised to the power 1. Discount dividend in year 1, you discount dividend in year 2, and it continues till you go to the last year. DN, dividend in the last year, which is also discounted. Then you add the price. You discount the price also. You discount the price also. You have dividend in the first year, in the second year, in the third year, in the fourth year till the last year. And then you discount in the last year. You have this dividend and then you have the price. And then you do a discount of that. And an example will help. You can copy this formula whilst I move you into the next formula, the generalized formula. And because it is estimated that we will hold stocks forever to the company, see, the stock is not like a bond that has a maturity date. So it's infinite. It doesn't have an ending date. Usually what is happening is that someone is selling his or her stock in the secondary market. So the generalized formula is a discounting of all its dividends to an infinite period. You have an infinite period. You are just discounting, dividend, because you never get to sell or never get to, the stock never gets to mature. So this is when you are dealing with multiple periods. The first one we did was just one-time valuation. And so let's look at a question to differentiate the two on how we will treat it. If you need to copy the formula again, please let me know. Morgan Engineering Company's common stock is being evaluated by an investor who requires a 14% rate of return. The stock is expected to pay dividends of $1 at the end of each year, each of the first 3 years. $1 at the end of each of the first 3 years, followed by a dividend of 1.2 in year 4 and 5. The stock is also expected to sell for 27.5 at the end of the first year and 41 at the end of the 5th year. Using the one-period valuation model, determine the value of the stock today based on the expected dividend and selling price at the end of the first year. Using the multiple period dividend discount model, determine the value of the stock today times T0 should be times 5. Okay, stock today times T0 based on the expected dividends over 5 years and the expected selling price at the end of year 5. So you have one doing one period valuation, the second doing multiple period valuation. Let's see. Let's try our hands on it. Okay. Emmanuel Gazy has the first one sent. Then Sam also has the first one sent. So question 1. Answer for question 1, Emmanuel Gazy and Sam. I've received. Thank you very much. Okay. Abdul is in, Raphael is in, Ernest is in, Emma is here. Gilbert is here for 1. We have Isaac and Papa Sam also sending their answer. Then I have Raphael, Gazy. All right. So that is the first one. Let's see. I have another one coming in. Dinah and Sandra. Thank you. Dinah and Sandra, thank you. I think, let me see. Okay. Then Gloria is also here. Thank you very much. So I'm unveiling question 1, answer for question 1. Yeah. Stephen, okay. Yes. So everybody's answer was 25. And the answer for question 1 is 25. Let's see the question B. Let's move on to question B, which requires is the new is the addition that we've done. So let's see how we are faring on that one too.
Madam, can you go back to the question so that we do?
Okay, yes. Joyce, thank you very much. Thank you for your answer. Abdul, thank you for your answer. Let me see. Ernest, thank you for your answer. I have Ernest, I have Gloria, I have Gilbert coming in. Thank you very much. Let's wait for some other 2 or 3 to come in and then we can move on. Okay, I have Ima, I have Sam, I have Kingsford. Let me see anyone. Gilbert. Okay. I think we have quite a number and we can go and look at what the solution should be. Yes. And so our final answer, 25.02. Most of us had it. In fact, every one of us who sent their answer had it. Thank you, Sandra. And it shows our understanding. It makes me feel safe. We are on course. Okay. And it's beautiful. We'll try our hand on one more question before we move to the next branch of the calculations. Let me look at the time. Oh, okay. 6 minutes to go. Should we? Let's try our hands on this one. Dividend paid by X Limited in the current year is 15 Ghana cedis. Equity capitalization is 20%. Equity capitalization is just like the discount rate or the required rate of return. Please mute your microphones for me. The investor wishes to hold this share for 4 years. At the end of 4 years from now, the price of the share is expected to be 367 Ghana cedis 0.25. You are required to determine the present value of the equity if the dividend per share grows at 16% per annum for the first 2 years and 14% per annum for the next 2 years. The dividend has a current, the dividend paid in the current year is 15. Market return rate is 20%. The investor wishes to hold for 4 years. At the end of 4 years, the price of the share is expected to be 367. You are required to determine the present value of the equity if the dividend per share grows at 16% per annum for the first 2 years and then 14% per annum for the next 2 years. Isaac, we are not on break yet. We are solving this last question. Then we'll go on break. Thank you. Okay, we have our first answer coming from Sam. Okay, Dinah, you have from Dinah. Sandra, thank you. Raphael, thank you. Joyce, thank you. Papa Sam, thank you. Okay, I have from Patience, from Kingsford. I know people are tired. Should we unveil the answer, or some people are still coming with the answer so that we don't keep everybody here waiting? Is anybody's answer still coming? Or we are done? Those of us who will do it, we have done. Okay, let's move so that since I didn't get any response, let's move.
Madam,
Okay.
please break. Oh.
Please hold on for break. Let me unveil our answer. And then, okay, so let's go. I don't know. I wanted us to see the answer and the difference in the answer. So you go and come. Let's go on break and come. When we come, we'll discuss how we arrived at the answer, because I see two different group of answers. So let's take a break and then let's return at, let's say the time is 4:10.
4:40.
So we return at 4:40. Yes. Thank you very much.
Oh, that's good.
We get something do and fast. December we come right, people they come out,
Matthew. Emmanuel, mute yourself, please.
Okay. Welcome back. I think we can continue. Let me open this thing again. Okay. I'm trying to project. Okay, beautiful, beautiful. All right, let's go. Share evaluation. Yes, this one. Okay. Where were we? We were here. Okay, this is where we were. That solved this question, and then we had our answer to be 2, 3, 1. Then I was going to check 231, 231, 230.7 was okay. I saw 221, 224, 221. Good. So Sandra and
Me supervisor call. It's the number one office now. We need to buy a guy we better now in China. I don't know what happened, but
Gina,
we end
please
up
mute
having a
yourself.
conversation.
Gina.
Even this week we are starting. Was it
Gina.
Wednesday?
Okay. I want to help Sandra and Dinah. Sandra and Dinah, you had 2 different answers. Yeah, am I? Yes, Sandra and Dinah. Can you? No problem, Gina. Sandra and Dinah, I want you to, I'm going to walk through step by step. We want to find you and know where, help you find where you went.
Dog, I got the steps correct. I think it was my addition that I got them wrong. Like when I was adding them.
Okay. Dinah.
No, please, can you go through the solution, please? Can we go through the process?
Okay, so we are at the beginning. Let me read the question again. Please mute your mics for me. Ernest. Okay, thank you very much. So dividend paid by X Limited in the current year is 15 Ghana cedis. The equity capitalization is 20%, which is a return on equity. Return on equity is 20%. Investors wish to hold this share for 4 years. At the end of 4 years from now, the price of the share is expected to be 367.25. You are required to determine the present value of the equity. If the dividend per share grows at 16% per year for the first 2 years and then 14% per annum for the next 2 years. Okay. The information we have is that D0 is 15, and then the KE is 20%. Growth is at 16% for dividend 2 years, and then the next 2 years is 14%. And then the price after 4 years is 367. So we put that in our calculation. This is the formula. D1, D2, D3, D4. And then the last is the price. D1, D2, D3, D4. Then in the fourth year, there is price. Okay. Price at year 4. To compute the dividends, we are looking for D1. For you to find D1, you need D0 into bracket 1 plus J, the growth. So it's our 15 into bracket 1 plus the growth rate of 16, which will give you D1. So D1 is 17, 17.4. Okay. If you don't understand anything as I move, then you let me know. So at least at this point, we understand why D1 is 17, which means the growth rate, we are using D0, we calculate the growth, and then we move on. So anytime you have D1 and you are looking for, you have D0 and you are looking for D1, you just go for increase your D0 by the percentage of growth, which is 1 plus the growth. Okay, so we have 17. Then dividend in year 2 will now become D1, then the growth is applied to it. So we have 20. Dividend in year 3 will be year 2 plus change in dividend, which gives us the third year, we are using 14%. So 1.4 times the last dividend price of 20.18, giving you 23.01. Then you go to the fourth year. The fourth year, you are looking for dividend using the last year's dividend, and then you add the growth to it. So your last year dividend is 23.01. You add the percentage of change, which gives you 26.23. So D4, 26.23. Okay. Then I'm moving on. Please let me know if you need explanations at each point. So now we look at the discounting factor. We have found D for each of the years. And now we are going to do the discounting. Remember that the D is over 1 plus KE. So that's what we are coming to do now. So for the first year present value, we have present value of the dividends. We have the year 1 dividend over 1 plus the discount rate. That is 1 plus KE. Over here, giving us 14.5. Year 2, same thing. Year 3, year 4, discounting by K1 plus KE. And it gives us 14.5, 14.01, 13.32, 12.6, and it goes on like that. So we get to the fourth year's dividend. Then you remember that in the last calculation, you will have to discount price. You have to discount price. If you look at the formula says you do dividend for all the time, then you discount the price. So I'm going there. We have discounted the dividends and we are going to discount the price. We were given the price to be 367.25. We discounted by 1 plus KE in the fourth year, and it gives us 117.07. All that is left is for us to add all the figures we have had from discounting. All the figures we have had from discounting D1, D2, D3, D4. And that gives us a total of 223.53 in present value. Any question any I don't understand this one somewhere, then we go to it before we move on, because we are building on. So if you need any clarification on this one, please let me know. No? Okay. Thank you very much. So we are moving to Gordon's growth model. Gordon's growth model. We understand that dividends will grow at a point. We don't expect that dividends will be stagnant, or dividends will continue to remain at zero. There must be growth, and to cater for that growth, constant growth. When there is constant growth, we use Gordon's growth model. When there is constant growth, we use Gordon's growth model. When we are dealing with one period, we use one period valuation. When we have multiple periods, we use multiple period valuation. But when there is constant growth, we use the constant growth model, which is Gordon's growth model. Okay, that one also gives us the formula: present value is equal to D0, dividend at 0.0, plus its growth rate, 1 plus J raised to the power 1 over 1 plus K. And it continues as such till we get to infinity. It continues as such till we get to infinity. This formula is, how do you call it? Simplified. Because when we talk about infinity, it means the growth is not changing. It will remain like that till infinity. So we use the simplified formula. When you have D0, you will use D0 into bracket 1 plus J, the growth rate, all over KE minus J. KE minus J. Remember that it is not 1 plus KE. This one is KE minus J. Then if you have D1 already, you use, so D1 into bracket 1 plus J is the same as D1. When you find the growth rate of dividend in year 0, it will give you dividend in year 1. So that is what we have written here. D1 into bracket is equal to KE minus J. For constant growth. And I'm stressing on constant growth purposely. When the growth is not constant forever, infinity, you don't use this one. Okay, please copy this formula, and then we will move on to the next phase. Now, there are assumptions to this. The assumption says that dividends are assumed to continue growing at a constant rate. You see, we want that constant coming in there. And then the growth is assumed to be less than the required return on equity, K. The growth will always be less than KE. Growth will always be less than KE. But constantly, there is a certain growth. Let's copy and then let's see. For an extended period of time, there is that constant growth. May not be even forever, but for an extended period of time, there is that constant growth. We use Gordon's growth model. Okay, the formula is quite simple. I'm sure we are done copying it. So we will try our hands on one question. A company just paid a dividend of 2.5 per share. Dividends are expected to grow at a constant rate of 5% per year indefinitely. If an investor requires a 12% return, what is the fair value of the stock? So we have our current stock price we are looking for. Our dividend has been stated, growth has been stated, our discount rate or required rate of return is stated. And we are using the Gordon's growth model. Okay, answers are coming in. I have Gazing, I have Gilbert, I have from Sandra, thank you. Ima, thank you. Papa Sam, thank you. Ima, that's answer, thank you. Then I have Ima, thank you. I have Sam from Sam. It's Sam. Thank you. Nadia, thank you. Joyce, thank you. Les, thank you. The break was good. Okay, Stephen, Raphael, Joyce, I have answers from you. Nadia, I have an answer from you. Great. Okay. Veronica, thank you for answering. Ernest, thank you. Looks like when we went on break, people went for energy drink. Energy is there, It's beautiful. iPhone. I don't know your name, but it's iPhone. Thank you. Patience. I've seen you. Thank you. Okay, I think we have quite a number.
Okay. Madam, please, it's Kensford. iPhone is Kensford.
Kingsford. Okay. Kingsford. Thank you very much.
Okay, madam.
Yeah. So I think we can look at our answer and see where we are getting. 37. Yes, I see 37. Everybody. Ibrahim, I see your answer. Everybody, 37.5. Everybody. And that's impressive. The energy drink is working. For some people, it was food. That was the energy drink. So it's working. Okay. All right. I also went to eat. So I've had my dinner. Yeah. Okay. We can try this or let me see if there's another. Okay, let's do. We always do 2 questions for. So let's do. Oh, by this one, I've solved the question. Wait, oh. Don't look at the answer. Close your eyes. Okay. We always solve 2 questions under one formula. So let's do this one to find the current market price of Coca-Cola stock, assuming dividends grow at a constant rate of 10.95. D0 is $1, and the required rate of return is 3. As for constant growth, the questions are quite straightforward. Looks like we'll finish earlier today. Okay. I have answers coming in from Nadia, and I have Emmanuel Gazy, Papa Sam, Abdul, Deborah, Gloria, Joyce, Sandra, Kingsford. I said it too. The break did some magic. Then Sem. Sem is the name Semenyu. I've been saying Sam. It's not Sam, it's Sem. Sam, what's the full name? Okay, let me see. You can type it out. Isaac Kwe. Isaac Kwanzi. I have your name, your answer, Gilbert. Irish Na. I have your answer. Thank you very much. A lot of us are answering, and I'm excited. I've seen names I haven't seen. It's just Sem. Oh, I see. Akpesi. Sem. Okay. All right. So I think that a lot of people have answered this question, and we can move on. Yes. I see 54, 54.15, 54.15, 54.2, 54.2, 54.2, 54.15, 54, 53.41. Okay, let me unveil and see. 53. 54. Yeah, 54 is the answer. 0.2, 0.15 is okay. 53 is too far. Too far from. So, the name is Abdul. Look at the solution. I don't know where you went wrong.
Yeah, I've corrected it. I've seen the correct one.
Okay. Thank you. That's great. Because I don't want to see anybody calling me for receipt. But we all don't want receipt. Yes. Brima. Yes, I see your answer. Thank you. We all don't want any receipt, you see.
Not at all.
Not at all. We don't want any receipt. So we'll take our time and we'll understand. When we make a mistake, we'll find it. And then, I mean, this is where we can do that. So I'm happy that you are also participating, and it makes the class better. Okay, so thank you for the solution. This is homework. It's for you to go and do at home. And send it to me. How will I receive it? I'll put it on the LMS. You solve it and also upload it on the LMS. Okay, so this one has a bit of, let's read. The company just paid a dividend of 2.5 per share. The dividends are expected to grow at a rate of 8% per share for the next 3 years. Thank you, Isaac. So the dividends are expected to grow at a rate of 8% per year for the next 3 years, after which they will stabilize at a growth rate of 5% indefinitely. If the required rate of return is 10%, what is the fair value of the stock? You can already start seeing the problem I've created here. If you read, you will see the problem I've created here. You have dividend paid, then you have dividend expected to grow for 3 years, then that growth changes to 5% indefinitely. So you see that there's some confusion or clash of titans here. It is homework. If we have extra time, there's one more question like this we will solve together. I left it purposely because I want to cover what we have to cover first. Okay. So when you have multiple theories coming in, what is the solution? So we'll look at that. This one with you take home. Today, then we want to look at securities market line or CAPM. CAPM is the technical word we know, CAPM, or in some books it will be securities market line. Then it represents the relationship between systemic risks and the expected returns. The relationship between risks and expected returns. Let me put it that way. And it's called the capital asset pricing model, CAPM. And then when you are using the table, there's a graph for it. That is where it is called the securities market line. That is when the graph comes into play. We call that the securities market line. But the theory itself is capital asset pricing model. Now, in determining risks, we have systemic and then unsystemic risks. We have systemic and unsystemic risks. And when we say a risk is systemic, it deals with a system and it affects large set of assets. So it is something that happens and the ripple effects affects, if not the whole stock market, to a very large extent. A large number of assets will be affected when you have a systemic risk. It is also known as the non-diversifiable risk. You cannot do anything about that risk. It's like a risk that affects the economy. And then that effect from the economy has ripple effects on every other thing. And thank God we have witnessed it before. If we haven't witnessed it before, it will be theoretical. We will just be talking about it in theory. But we have had the chance to witness it before. One thing happens and then the effect is running all over. That is a systemic effect. It could come from inflation. It could come from interest rates. It could come from COVID, a national disaster. It could come from effects from foreign trade. It could come from like perhaps something that as a country we take our raw material for production from another country, and that other country is in crisis. You realize that their crisis affects us, and then it's a ripple effect. So in relation to stocks, it is anything that can affect the market itself. The market itself. An example is the financial crisis we went through as a country, and we saw the ripple effect on all shares, all stocks, and majority of investments that people made. So that is a systemic effect, and no one company can do so much about it. Every company will manage it in their own way, but they will still feel the effect of that risk. The advantage is when your company doesn't have huge unsystemic risks. So what is unsystemic risk? These are risk factors that affect just limited assets. They are peculiar to firms, firm specific. They are asset specific. It's like you are buying MTN and the crisis is only on MTN. That is unsystemic. It has nothing to do with the system. It has nothing to do with the economy. Let's say that MTN, God forbid, MTN's lines go down. And for about 2 weeks, they are not able to work because majority of their satellites have gone down. You can imagine the chaos it will create. And they are the largest network company in Ghana. Most of us are on MTN. Yes, Sam, they are like inherent. It's yes. Let me put it that way. Like inherent, yes. So you are dealing with unsystemic when that one does not affect a lot of, maybe it's company specific. That let me put it that way. Okay. I'm trying to